When somebody asks a trader, what is your strategy, quickly follows a list of confluences that people use. Elliott wave theory, smart money concepts, support and resistance, trend line, inducements, the list goes on. You can see it on the chart, and that's why it can be very easy to learn and therefore easy to trade. But then the question remains, why do 90% of traders consistently fail? And that's why today I'm going to be showcasing to you a hidden edge, something that most traders are not even talking about. For example, when somebody decides they're going to trade something, they will look at that asset class's price action to determine a technical strategy and a technical bias. But what if I told you that it's important to recognize market correlations, because there will lie a hidden meaning to showcase to you a signature of a manipulation. And today I'm going to be walking through exactly this hidden manipulation that happens every single day, where I'm going to be teaching you through diagrams, and then I'm going to be sharing with you a real live trade from today, nothing cherry picked, something that I caught and dozens of my members caught alongside me. So in order to best define a hidden manipulation, we must first understand and define what is a manipulation in the market. I'm just speaking about market mechanics, liquidity-driven markets where trillions of dollars transact on a daily basis. And how does a liquidity-driven market work? Well, you have a market auction where if I'm looking to buy, someone has to sell it to me. But what about when you have large institutions? Let me show you. So for simple maths, let's just say 100 orders from institution X is ready to buy. So they're ready to buy at the price point 1.2000 at the time 9 a.m. They're ready to buy 100 units. So let's plot this out. At 9 a.m. at the price point 1.200, this is where price is right now. Perfect. So we have now found efficiency where the market has reached the price at the time that the institution wanted, and they put in their orders of 100 buys. But the problem is at this price point, there's only 80 sellers. So now there is a deficiency between the 80 sellers that are in the market and the 100 buy order that the institution wants. There is a 20 units gap. So what can the market do? How can we invite in more sellers? Well, then the market can tick higher, where it can say, hey, we're now coming to the price 1.21. Are the buyers a little bit later in time now, are they willing to accept a higher price? Because they only were able to offload 80 of their units. Are they accepting a higher price? 1.21. And you might say, okay, they might be willing to accept, but not the full 20, maybe only 10 units. So now 10 units are sold at this price point. But of their full order of 80 plus 10, we have only found 90 units of the total desired 100. So they push price higher one more time and say, okay, what about 1.22? And in this price point is pretty high now. There might be 100 sellers ready to say, hey, I'm ready to sell at this price point. But the buying side says, hey, no, I'm out. I'm not interested in this price point. So now there will be more sellers and price will go lower. And therefore a price action signature like this will be a price drop. But the problem becomes that the institution didn't get their full orders into the market as they would have wanted, because there was not the participation. Whether it's the institution is not willing to accept higher prices, or at the lower prices there's not enough sellers. So the counterparts are not aligning. So what can the institutions do about this? So as we scale higher prices from 1.2 to 1.21 to 1.22, the 100 orders that the institution had, well, initially they could offload 80 because there was 80 accepting from the seller side. And then when price went higher, then they were only willing to accept 10 more orders of the remaining 20, but there was a lot more sellers. And then at the 1.22 mark, well, the buyers were not interested, too expensive for them, but there was a lot of sellers involved. So this is not an efficient market, because ideally it would be 80 goes to 80, 20 goes to 20, and then 0 goes to 0. And that would be an efficient market where the auction is complete inefficiency. But the reality is the market doesn't move like this, which is why a liquidity-driven market will have manipulations. It's not a conspiracy, it's a fulfillment process to enable the market, to make the market more efficient, and even the matching algorithms will drive price higher and lower to facilitate these kind of things. So to define liquidity and manipulation better, this is how I'll do it. Is the intentional conduct designed or engineered price to deceive or mislead other market participants? Put simply, price will present in a way to deceive and confuse other participants. And this happens by the markets moving into an area that is crowded with stop losses and pending orders. So a concentrated area of price where there's a lot of activity, there's a lot of orders that can be matched up, which is what we're looking for, liquidity in the market. And this is going to be used by the big players to trigger those orders in order to fill their large positions. It's accessing liquidity. So just as we mentioned, we are engineering and creating price to invite in other market participants in order to facilitate and access the liquidity that the big players need. So what that's going to look like is if we go down here, we will see that as price presents, we have an option like this, which is a simple trend, where as price goes higher and higher, it means the buyers are willing to accept higher and higher prices, and sellers are coming into the market and willing to sell more and more because price is getting higher. It's a better price for them to sell. But this for the big players is not efficient, because then their average price is climbing. Instead of them getting in over here, they're having to get in over here and here and here to complete their large order. So instead of the average price being down here, now the average price has crept up, and on average maybe now their aggregated price is here instead of being where they initially desired down here. So that inflation in price of their average buy order is an inefficiency. So instead of that, what they could do is move and engineer price in a way where you will invite in liquidity. For example, this support level right here, what do we know is going to be happening? Well, alongside the big players, there is going to be a lot of people buying up this level because it's an obvious area of support. Well, you might be thinking, isn't this counterintuitive? Because if the institution wants to add 100 orders, but then all of these other market participants are seeing this obvious support level and they're adding in another 100 and they're adding in another 100, this would be counterintuitive, because now we have a lot of buy orders concentrated and not enough sell orders ready to sell to them. So it seems like a greater inefficiency in the markets. Well, this is where it gets interesting, because we have now found a crowded area in the market where there is a lot of orders. There's a lot of buy orders pending, and there's a lot of stop losses right below, meaning all of these orders that were present, the 100, the 100, the 100 that we spoke about, all of these buy orders have their stop losses resting below. And what does a stop loss mean? It means a buyer is no longer interested in holding that and they want to get rid of it. A stop loss means they now become a seller. I hold gold, and when I'm no longer interested in my gold price, I'm no longer liking the price action, I'm going to get rid of my gold and sell it at my stop loss price. So meaning to say, when price flushes lower below this obvious level of support and goes for those stop loss hunts, it's actually inviting in sellers. So when price shoots lower now, we have flushed the liquidity. We have flushed out all of these buy orders who have now become sellers. So they have become the sellers that the big institutions wanted. Now the big institution can easily buy up the liquidity that they needed through all of these stop losses that are now taken out in the market. We access liquidity to fulfill the big order that the institution had. Furthermore, when price action presents like this, what happens? Well, then sellers are going to get interested because they're going to see break, test, continuation. When you see a support level turn into a resistance level, they're going to be entering sells and their stop losses are going to be here. So now we've introduced more selling pressure into the market. And when price shoots higher like this, well, then these buyers tag along because those sellers have exited the market because of their sellers stop loss, and that becomes a buy position. And now it becomes a catalyst to push price higher alongside the institutional intent. So as we spoke about, more buyers in the market means they are willing to accept higher and higher prices. So if the institution can get in down here and put in their 100 orders, and the counterpart is going to be all of those stop losses, and then when price shoots higher, we use this as a further catalyst because these people are willing to get out and they're getting out of their sell positions by buying it. Meaning to say, a manipulation like this, a sweep of price lower, enabled the big players to get into the market, access the liquidity, and then also became a facilitator to allow price to drive higher. And that's why we call it a manipulation and engineered price action, because price action was presented in a way to invite in stop losses, invite in pending orders, and invite in other market participants' behavior. So this is a typical manipulation. So the purpose of this video, however, is a hidden manipulation. So what is that going to look like when you cannot see it in price action? Well, it's going to look something like this. When you have a zone of consolidation and then price just goes higher and higher. And you might be thinking, well, where is the manipulation? It's just a sequence of low in the market that made a higher high, that made a higher low, that made a higher high, higher low, higher high. Isn't this just a trend? Isn't this just market structure? And what about all the stop losses that were in this area, below this area of obvious supports? What about all of this liquidity that was resting? Why did the market not go and grab it? Well, this is where the hidden manipulation comes in. And this is where divergence and correlations come into the market. So you need to find two things that are heavily correlated. If you're not sure the positive correlation of what you're trading is, then just put it through ChatGPT. But an easy one, for example, is going to be Euro USD, which is something that I trade a lot, is going to be heavily correlated to something else that I trade a lot, which is GBP USD. Why is that? Because they have the USD cross pair in common, and both of these pairs, typically speaking, will have very correlated price action. That when you form the highs in the market, the highs will be the same, and the lows in the market, the lows will also be the same. The nuance becomes very, very similar, and you can see that it's almost identical price action. Not always perfect, but the big moves will always follow together. That is a correlation, a correlated asset. There's going to be many of these all across the market. You're also going to have inversely correlated things. For example, the Canadian dollar and oil. They are typically known to be inversely correlated. Or another one is going to be gold, which is typically seen as a safe haven. So when major markets crash, gold will usually fly higher. Another inverse correlation. So find the correlations that are important for your currency pair or your asset class that you trade, or just take it from me. This is one of my favorites. And these are the two pairs that I exclusively trade now. And the reason being is because of these divergences. So in this currency pair, we've built up liquidity. Here we've built up liquidity, but the difference is over here, we are not breaking lower. We are forming higher highs, higher lows, higher highs. So this is what I want to pay attention to. Whereas in this currency pair on GBP USD, instead of forming the same bullish market structure that we see something a little bit different, where we see price shoot lower and then shoot lower. And then maybe it starts to creep higher and higher, the same way that EU did. So why can we see a temporary portion of depegging? This area in purple I want to focus on, because here's something pretty important is happening. And that is, on EU, price formed a sequence of higher highs with multiple touches, almost like a trend line. Whereas GU formed a sequence of lower lows, almost like a bearish trend line, where we had a low and then a lower low. And on EU, we had a high and then a higher high. So what is this divergence or depegging known as? What is going on here? So what I'll do at relevant portions in the market, I'll mark it out. I'll say, okay, price is going higher over here, yet it's going lower over here. This is a temporary depeg in a correlated asset. Why is this happening? Well, this shows to me that if there was liquidity and stop losses in this area, this became the sweep in price action that we just spoke about, the manipulation that didn't happen here. But if they are correlated, it's showing me that there is still a mirrored movement, just one of them has induced and manipulated, the other one hasn't. So I can still trade EU with this information that I can add to the table and say, well, EU's price action is showing me normal bullish price action, but I can still get in because I'm enhanced by this inducement and manipulation to showcase to me that GU is getting that catalyst that we needed. The big players are getting in and price is likely to move higher, so I'm also able to buy EU. Well, you might be thinking now, well, why don't I just trade GU? What's the point of me trading the hidden inducement in EU? Well, the purpose here is maybe the higher time frame is better on EU. Maybe the context is cleaner on EU. The execution point is better looking, whereas GU might be in no man's land. EU might be in a point of interest. So there is benefits to trading one currency pair and using this as a nice cherry on top confluence, even if it's not in the same thing you're trading. Another benefit becomes when you are trading something that is the market structure bullish that we see on EU. This is a benefit because you can enter upon a block and you put your stop loss at the low. So you have a precise entry and stop loss region. Whereas if you're trading something that was a build up and a sweep, how do you enter over here and where do you put your stop loss? Because what if it keeps sweeping? And what if it's not ready? You need to see the confirmations of the rejection first, and you're going to be entering quite late, whereas you could enter quite early on EU. So it becomes an assistance in your entry as well. If you're not following, don't worry, I'm going to show you an exact trade example showing you this step by step. So before I get into the actual trade, I want to show you how many members caught it, and it's literally from today. A few people were selling in London, but I want to show you the New York buy. And we can see a lot of these New York buys. We can see Russell got in over here. We can see his entry on the right. Edgar also got in. We can see his entry down here on MetaTrader. All of these traders are catching the same trade. Usman over here, you can see his MetaTrader. He had a good day. He sold and bought, and we can see it goes on and on. These traders are catching the same trades every single day, and I want to show you there's nothing cherry picked. This is literally from today's price action of the same trades getting caught community wide. And by the way, the Discord is just a snippet of what we have inside of WWA. What we have built inside WWA trading is truly pioneering at the forefront of technology, where we are embracing not only one-on-one coaching, not only daily live streams, not only community-wide journaling and the data we can find and highlight the mistakes in certain members, but actually all of being wrapped up and powered by AI to have custom solutions. Everything is custom, which is why we are a leading education company. Not just a course that you buy and we send you the recordings and we hope you figure it out. It's a full end-to-end ecosystem. It's about real results and transformation through practice, which is more important than theory, and implementation of the concepts in daily day-to-day price action. And because we do one-on-one coaching, naturally we can't take on thousands of people, which is why we have WWA as an invite-only process through an application form you can find in the link in the description. So through the application process, if we see we are a right fit for each other, we'll happily invite you into our ecosystem. Or if for whatever reason we are not a right fit for each other, no problem, we will still leave you with some goodies to make sure that we leave you better than we found you. So let's start off looking at GU. On the higher time frame, you can see we are just clearly bearish. We are printing a series of lower lows, lower highs, lower lows, and it just goes on and on. So you might be thinking, the trade that I'm looking for is a buy. How can I look to buy when we are not in a demand area on the left and we are just in a bearish market and we haven't even had a lower low to make a higher high? We haven't even had a bullish break of structure. Isn't it pretty dangerous? Are we not just catching a falling knife? This is where the hidden edge comes in. But this is something else that I want to show you. This is a hidden divergence, but on a higher time frame, not only to get an entry, but to generate a trade idea. The beginning point of a trade, the ideation step, not the execution step. We're using this through the hidden edge. So when I look at the 1 hour, it's just simply bearish, just like this we can see. And therefore, if we are expecting a bearish market, we are expecting the main push bearish that's happened, retracement to make the lower high, and we should go on to make a lower low and break past this level. But if the market is to switch and become bullish, then we expect this lower high that made the lower low to now go on to fail to make a lower low and go on to make a higher high, a switch and a new trend. How can we expect that if we haven't had a clear inducement? Because there's no build up on the left. If there's no POI, if there's no demand area that we're buying from, we are in no man's land. How can we expect a trend reversal out of nowhere? Or how can we anticipate it? Because we're before the trend reversal here. Well, this is where we have to pay attention to the details. Well, putting them side by side, we can see very clearly where we have the same lower lows and lower highs. So we're getting the same trend set up until this point where we formed a lower low over here on Friday the 31st of October, and over here on Friday the 31st of October at the same time we formed a lower low. But now the difference here is after that we had a push higher, whereas here we had a slight push higher. And then after that we had a bearish push lower, but we failed to break lower. We didn't break past this low over here. This has become a protected low. Therefore, this is the lower low in the market. Whereas over here, the same bearish portion that I'm mentioning over here is a little bit different because that bearish portion has not respected the low. Over here, it's a respected low. Over here, it's gone lower. So this is the divergence I want to focus on. Okay, so we can see we have very similar price action. Starting here, we have the lower low. Over here on EU, we have the same lower low. Then we have the retracement higher. And then we have the main push lower, which is the bearish leg, which is the red arrow. We have the same red arrow here. The break of structure point is the same over here and over here. And then we have this lower low in the market, which is the floor in price. That same lower low on GU is not broken. We are forming a higher low. So we can see that this is angled up. It's respecting. But on EU, it's the opposite. It's not respecting and going higher because we broke down and it's actually lower. So you can start to see this is where the divergence comes into action, where we can see a low in the market has led to a higher low, whereas this low in the market has led to a lower low. This temporary divergence of one forming a higher low, the other one forming a lower low is a manipulation. There's no reason for it to depeg so significantly unless this lower low is only a manipulation, and then it should recoil higher just in the same way that we expect GU to do so. And therefore we can anticipate that this divergence is a symbol to say this is just a manipulation, because maybe on EU there was not enough liquidity, so they engineered it, they manipulated the market to access liquidity to get the buy orders in, whereas on GU they didn't need to. On EU they needed to manipulate. Temporary depeg, one of them is a manipulation. This gives us a head start. This is almost like a crystal ball to say if one is manipulating and is going to go higher, well then the other one probably is going to go higher too, just without the manipulation. This means on EU, it might be pretty hard to guess where is the low because it might keep going a little bit lower. Whereas on GU, we have a pretty clear low. We know that this lower low is the respected low. So if we can find an entry, we know it's not going to go lower than this. We just need to find the correct rejection in this area. And we know this should be the protected low, enhanced by this manipulation, foreshadowing to us that price will go higher. So with this divergence in mind, then I can treat it as an ordinary setup. I have now found the directional buy price and the divergence to confirm the zone of interest. Even though the higher time frame is not a demand area, even though this is not an inducement, we can still call it a demand, even though it's a lower low and it didn't even form a higher high yet. It didn't even break structure. So it's just a lower low that we are calling a demand. Typically, this would be a cardinal sin in trading. We are utilizing this as a confirmation. And after this, we can now just focus on GU and say, okay, now we found this information. Then I just follow my normal trinity. I look for the daily cycle variation. I look for time window. I look for lower time frame confirmation, and I look for inducements. If I see all these things, I can trade this normally because I have this information of the divergence, which I otherwise wouldn't have been able to, because this is just a bearish market. I should expect it to go lower. I can still look for buy opportunities. This is why it is powerful. So reading through this daily cycle variation, it's very simple. We are in a bearish trend. We come into the previous lower high that made the lower low. We find that supply area. Once price is in that supply, we can see that we have a build up, inducement, Asia high build up, inducement. So we are seeing inducement number 1, inducement number 2 into supply zone, inducement number 3 into supply zone. We are getting this low in the markets that is forming another lower low. We are getting a bearish impulse, retracement, mitigation of that previous inducement. Very, very simple price action. And then we are continuing lower. So this is a very clear bearish manipulation, daily cycle variation, until we see the hidden divergence, which is telling us, hey, this may reverse and the bearish trend may be coming to an end. So let's now focus on the details. So as we come into this key time window, first thing I need to do is flush liquidity. There's always going to be some form of inducement. And in this case, we are taking out this trend line liquidity that we can see in association with London low. All of this is a manipulation, and we have now induced down to this demand area, only a demand area, even though it's a lower low, because of the divergence. We look into this area and we say, oh, what's gone on here? Pretty interesting. Dropping down to the 1 minute time frame to see the details, we can see that there's a lot of things going on over here. Information we can utilize where we have a buildup of liquidity, we have a sweep lower known as an inducement, and then we have a bullish reaction known as that break of structure, and then we have a block over here that caused this inducement. We get a mitigation of this, and therefore this is the area that is left unmitigated. We can just take the block over here. The block, remember, being that it is the last sellers before the bullish push. So over here we can see the seller's pressure, the last seller's pressure that caused the inducement to take out this liquidity enabled the bullish break of structure. Same over here, the last bearish pressure before price went higher. So we just mark it out and we say this could be our potential demand area. We see if we are inside this demand area in the key time window and we are seeing a rejection after an inducement, this could be an opportunity. The same thing I always say, time, lower time frame confirmation, inducement. So what do we see? My gray box is my indicator to tell me my key windows. We are in the time of the gray box. So time ticked. Inducement, yes, we have taken out this trend line liquidity. This trend line has now failed and London low is getting swept. So we've now found inducement. And we are in the key area. And this is where I need to focus on. In my blue box, which is the refined mitigation area in that previous zone, it has the divergence to confirm it. I just need to see a lower time frame confirmation because I have the inducement, I have the time window, and it could be something like this. Right here, we can see a bearish push down, which is right here. And then we need a 1 leg, 2 leg. If I can see 2 bullish legs, I can get in. So first leg is here, which is this one. And then second leg is this one, which is this one. And therefore I can enter based on that 2-leg protocol. I can actually enter a buy position over here. Stop loss at the low, 3 pip stop loss, which is perfectly in my normal range. 3 to 7 pip stop loss as always. Break even on the M1 shift. So this lower high that made this lower low, if it forms a higher high, we can now do a M1 shift break even. And then as always, I take my first partial at the 1 to 3 risk to reward. And as always, the second partial at our 1 to 10. So now that the trade management is locked and loaded, we have got our entry. We just now see how it plays out. Remember, this trade is the same trade that all of the members caught today. Nothing special, nothing cherry picked. And as you can see, in the space of just a few minutes, we break even. And then in the space of just another minute, 1 to 3 risk to reward. And then this potentially flies all the way to our 1 to 10, let's see. But the point here being, this is a typical trade, a typical price action that we trade. High risk to reward, high win rates. ordinarily a trade you wouldn't be able to take if you're trading supply and demand and sweeps and all these things, because you'll be seeing a lower low, not a demand. But when you focus on the divergence, or I like to call it the hidden edge, that's when you're able to actually see that divergence and find this opportunity which you wouldn't have otherwise. And taking it to the present moment where I'm filming it right now, it has already crossed our 1 to 10 risk reward right here. So in the space of just over 1 hour, we were able to catch 30 pips with a 3 pip stop loss, so a 1 to 10 risk reward. I caught it, the members caught it, and this is how you gain 6.5% in a single hour, in a single session, utilizing the average session volatility. Not a home run trade, not an anomaly, not super aggressive movement, just a pocket of probability. I'm not even looking for the whole move, just a window, a pocket of higher probability, starting with the hidden manipulation and then following the trinity that we always do, which is time, lower time frame confirmation, and inducement, leading to a high risk reward, high win rate, profitable trading system. Now, what I'm sharing with you today is important, but it's only a piece of the puzzle, because in reality, I cannot share a decade worth of trading experience that I have in a short YouTube video, which is why I've prepared for you a full 3-day course for absolutely for free. It is from zero, no matter your experience level, no matter if you don't know what an inducement is, a POI is, don't worry. It's a step-by-step from zero to a profitable scalper. Literally thousands of slides with diagrams, case studies, charts, examples, everything that you need presented in a clear way, and it's going to be sent directly to your inbox. We don't need anything from you. If you message me on the WWA Trading Instagram page with the word course, we'll send you the full 3-day program directly to your inbox, no strings attached, no payments, and you can watch it and enjoy it and benefit in your own time. But as always, as you know, you need to refine your craft, and the only way you can do this is if you remember that a restricted trader is a profitable trader.